As you were, that's enough of all that relief rally nonsense. The Dow Jones jumped 139 points on the opening last night and then tanked when the latest ISM manufacturing index showed a much sharper fall than expected. And that was after weak GDP data on Friday and the big downward revisions to previous growth estimates. In other words, the US economy is weak and the government is cutting spending by $2.5 trillion. It all got a bit too much for the markets and they went into a funk in Europe and Asia as well, which led to a 1.4% drop by the All Ordinaries today, with some quite chunky falls by the banks. Westpac and ANZ were down 2% each, and the retailers, Myer down 4%, Harvey Norman 3%. It means the local share market is back to where it was a year ago, 4,500. It's been a heartbreaker for investors who are starting to recover some of the losses of 2008, only to find European and American debt has eaten the gains. The currency is up 20% in the past 12 months, but we have to shop overseas to take advantage of that, which is, of course, what many are doing, and is one reason why rates were left unchanged today. And while the RBA board was meeting today, they would have been given building approvals numbers for June, a final nail in the coffin of a rate hike. Approvals fell 3.5% instead of going up, as expected. So here's what the futures market is now pricing in for the cash rate over the next 12 months. 42 basis points or 0.42% of cuts. And finally, the Australian dollar is sitting below 109 US cents tonight. It sank like a lead balloon at 2:30 when the interest rate decision hit the traders' screens. And that's finance.